Good morning. Good morning. For those of you who are um, here, okay. My name is, of course, Gloria Bradley. Your realtor here, and so one of the things that I actually do, and I started, and if you see the flyer, every second Wednesday, I want to be here to ask questions um, and probably talk about a topic too. So again, my name is Gloria Bradley. If you put in the comments, if you have a question, those of you, I'm going to check my phone because I got also people either texting me a question or um, I may have a guest coming to my Zoom room. And so you're going to see me kind of going back. I got kind of some double screens that are here. And so I'm just going to be here from 10 to 11 to ask, ask questions and kind of conversate about buying and selling. Um, as a realtor, I'm considered essential. Hey, isn't that great? That I guess in a sense, we're not in a real estate crisis, even though, and part of that is kind of so because um, we also have a lot of people who own real estate who mortgages is not being paid. A lot of people who do have mortgages are um, using deferment and things like that. And so, and one of the things is that actually, this is, I thought I was going to have a lender here, and actually, they're texting me right now. So let me see here. This is always great to bring in professionals to talk about a different topic. Hold on for a moment. All right. So, hold on. Let me see if he's still going to be able to come in. All right. One of the questions I get a lot is, is it a seller's market? Is it a buyer's market? And, for me as a, woman of faith and that's one thing I want to talk about faith because we all have faith in something. Even sometimes I sit down in this chair and I didn't even think about that it would not hold me. Okay, so um, but for me, it's there's a time and season for everything. There's a time and season for the things that are happening in our world that's happening in our life, and so my question to you is it your season? Is it your season to purchase, or even is it your season to actually sell? And so we see right now due to COVID-19 and um, that people are still buying. Actually, after I finish this, I'm gonna be headed downtown Long Beach to actually show a property, and just closed on a property last week. I have some clients. We sent out an offer. I got some offers on the table. What does that mean? And we can kind of talk about that. But so activity is still moving. I have $1 million house in Claremont. Anybody want to buy? I'm still looking for a buyer. So, so real estate is still happening, but it's really about, kind of like inventory that kind of really, when people say, okay, it's a seller's market, it's a buyer's market. Right now, interest rates, and I'm hoping my lender will come on. Let's see here. I want to keep an eye on, he's going to join me in this Zoom. So when you don't, well, let me just say this: interest rates are really low, so a lot of people are refinancing. But also too, we have a lot of people who are looking to actually buy because interest rates are so low. And so a lot of times, let me see, I think I got my, let's see here. So a lot of times, so a lot of times you have new you have more buyers. If you have more buyers looking to purchase, then you actually have homes to purchase. It becomes more of an advantage in the sense of the sellers, because you got, I'll give you an example. One of my listings, I had like about almost 20 offers for this one listing. So that can create where people will offer more than what the property is worth. Um, and so it becomes more of a sellers, because sellers can sell property maybe a little higher. Um, and then some of you are probably like, well, how can it be higher? Well, even though if you get an appraisal, when you get an appraisal on a property, and say the property appraised for 450, well, if you're willing to buy that property as a buyer, you may be willing to pay 10,000 more, 15,000 more, because you want that particular property. So I think my property, when I bought it, I put down probably, I think I paid about $1,000 more, and that was a lot back then for me, than what the actual property appraised at, because I wanted the property. So I paid an extra $1,000. But here's the thing too, is that now my home has pretty much, doubled in value. So, oh my God, hold on for a moment, you guys. Hold on. Hold on. So, give me just a sec here. So as I was saying that, so that's kind of where it goes between like a buyer or seller's market. Now check this out. When I was purchasing, um, there was more there was more inventory, because it was right after the, and also text your, if you have a question, or please put it in the comments. I'm gonna put a good morning here. Or you can also, on the flyer on the page, you can also join me in um, on the Zoom, if you want to kind of, come into my little Zoom here and so forth. So, but so when I purchased my house in 2008, after the real estate market crash, there was so much inventory, so much inventory. Okay, so it was more beneficial to the buyers because it was so much inventory to sell. So the amount, or the to purchase the property were less than you can get a deal, should I say. Uh, I'm gonna go look at this condo downtown Long Beach today, and in 2000, when I was looking in 2010, 2011, I bought my home in 2011, and in 2010ish, um, this same condo that is in the threes were around like in the 50s. Okay. So it just shows you how the difference of when you have so much inventory, it's cheaper to buy, and you have less buyers. So in regards to, um, whether, hold on for a moment, I'm gonna, in regards to whether it is um, a seller's or a buyer's market, it really boils down. Is it your market? Is it your market? Is it your season? Is it your time? And that's really what it boils down to. Is it your time? Now, I will say that, the market, like I say, the market, some people that I was trying to help to, to get property, if they would have bought it back then, they would definitely have some, some equity, in, hold on for a moment. They would definitely have some equity in their home right now. Hold on. So is it this is a time, this is like a working live, answer your questions, bring on some people, just want to come at you. So is it your time? Yeah, that's really what it boils down to. Is it your time? Are you ready? Now, those of you who that I have worked with and have the opportunity to work with, um, in buying a home, is that it took faith to, to actually to do it. It took faith. It took faith to what? To do it. So is it your market? Is it your time? Is it your, is it your season to actually buy a home? Now, it takes a lot. I was talking about faith earlier, and when you're purchasing and so forth, um and it takes faith to actually to do it. And I was talking about this earlier with my, prayer and study group, um, that I'm a part of every morning. And just for you guys, yes, I always tell people when I do seminars, and I really miss going and actually speaking, done seminars for many years for, West Angeles, home buyers, um, class that they've had for many years, and so I really miss being, in the classroom. And so, actually, we have our guest, lender that's coming in here. So let's see here. Hey, Joseph, I see that you're connecting. We're live here on Facebook, and so he'll come in. So, but as I was saying, was that, I miss, teaching in the classroom and so forth. And, so Joseph, I'm streaming live on, free real estate seminars. Um, Website is is where I'm at streaming from. And so we'll welcome, Joseph, here, and I'm gonna introduce him in a moment. But, as I was saying, is that, I miss teaching in the classroom. I love teaching about buying a home and selling a home. And as Joseph, he's going to, um, um, come in and share about where interest rates are, and so forth. But, like I was saying, it takes faith. Is it your time, and is it your season? And, one thing I could say about Joseph has helped, many of my clients, become successful, and not only just getting an approval by a lender, but actually purchasing a property. And it takes faith to do so. And so it's, and it takes hard work, because, and I always say, when people say, is it my time and my season, you have to find out, where you are when you're buying, or when you want to buy. And I've had clients, and Joseph can testify to this, is that we have clients that we work with over a year. We still have some on the books that are still just waiting for that perfect moment. They're ready, they're pre-approved. We're keeping, them up to date as far as keeping their employment and all those documents that are needed to stay current with the lender, because when something comes available, you want to be able to jump on it and be ready. You want to be able to jump on it and actually be ready. So, but it is a faith walk, but you have to be able to, you got to take that step. You have to take the step in order to find out, where am I? And sometimes we shy away because of our past. We shy away because, oh well, I got bad credit, or I did this. And sometimes we find out that people say, oh, I got bad credit, I did this and that. And then we go and look at their credit report, and they realize that those things are not on there anymore. So, but you don't know until you actually know. Okay, so you don't know until you actually know. And so you have to find out, and you have to find out. Let me just leave it there. Find out what's happening. Find out what's going on in your life. And sometimes even digging deep, or even looking at what you did before. Sometimes it can be kind of not necessarily scary, but the fact that we a lot of times have to look into the things we did in the past. But don't worry about the things you did in the past. Think about, where am I now? I'm not who I was when I was doing bad credit. I trust me, I've had bankruptcies in my life. As a when I was in my 20s, I got too many credit cards, and bad relationship, just buying stuff, had to file bankruptcy. So I've had some up and down roller coaster throughout my life, you know, um, with credit. Even after I purchased, and that's something I learned about, having being debt free and having those extra savings can definitely make a difference as well. So even after I purchased, I end up my credit went down a little bit, and then it went back up, and so we can repair ourselves. We can do those things. So anyway, it takes faith, and we're going to talk more about that. But let's welcome Joseph. Come on in, take yourself off mute.
Good morning, everyone. Sorry for being tardy. Technical issues over here on my end. I'm with Caliber Home Loans. Just really quick information about myself. I've been doing home loans since 2002, so we're approaching 20 years. I've been with Caliber Home Loans for about 5 years, which is an eternity in lending. Most loan officers hopscotch from one company to another, anywhere from 12 to 24 months in. So Caliber's an amazing company. They not only originate loans, but they service loans. They have a portfolio of almost 200 billion worth of loans, mortgages that they service, where people make the payments to. Brokers also use Caliber Home Loans as well to submit their loans to Caliber as like a correspondent lender and what have you. So I've been doing this for a long time. When I started, I had a full head of hair, and now that is gone.
Hey, I got your hair now, Joseph.
That's right. I will pay good money for hair that sticks.
Hey, Joseph, this is my hair, okay?
So, but let's talk about affordability, right? I think that was something that you touched on. It's crazy to think, with home prices where they've gone in the last 3 or 4 years, with home prices being as expensive as they are in Southern California, whether that be San Diego, LA, Orange County, home affordability is actually better. Affordability is higher right now than almost ever before. And I'll explain why, right? So believe it or not, even with COVID and people being laid off and staying at home, the average hourly weekly earnings of Americans is actually rose 5.9% year over year, which means people are making more, averaging more weekly, meaning they're bringing home more each week, and they have more money to spend on a house, for instance, each week. And so they're able to spend more and afford more on a house. In addition, mortgage rates, if we compare rates right now, interest rates on a 30-year loan to the same time last year, rates are 1% lower than they were last year. So a homeowner who was on the fence last year and is still on the fence this year can technically afford roughly about $40,000 more in a home price today than they could last year based on the overall payment created by the interest rate on a loan.
Same time last year, rate.
So that's something that I think is profound given the kind of the crisis that we're in regards to, there's not a lot of inventory, which means that there's a lot of people fighting for one house, which pushes the demand up, which causes the interest, the price of that home to go up a little bit. And yet we still, as a homeowner, as a potential buyer, we still can qualify and afford that property. And I think sometimes as first-time home buyers try to get accustomed to or comfortable with that payment shock of renting to owning for the first time. Sometimes it's hard mentally to make that leap of saying, hey, I've been paying $1,500 a month in rent. And now when you factor in my property taxes on a house and my home insurance on a house, that payment is going to go potentially from $1,500 to $2,000, $2,500, or what have you. Sometimes it's hard to say, hey, I can handle that payment. Mm-hmm. But when we're looking at it on paper, black and white numbers, and we're measuring your income to your expenses, and banks are risk averse. So banks are not going to want to shell out hundreds of $1,000s to a buyer who is going to be over their head and drowning in mortgage payments. So if we've got a bank or a loan approval for a buyer and saying, hey, you're approved, then the reality is we're comfortable with lending that money. And so it's just a matter, I think, sometimes of people understanding, hey, how does owning a home work? What benefits come in play once I'm owning a home? What kind of tax deductions will I get, or tax breaks will I get when I have to, when I'm able to write off potentially interest on a home or have repairs on a home or something to that effect? So I'm going to take a little quick breath and go back to Gloria. And Gloria, is there anything that you want me to touch on that I haven't already addressed?
Joseph, that's some good stuff there, because one thing I could say going for myself, going from renting for so long and going from owning, I only end up paying, just $100 more than what my rent was, and so that was awesome. It's like, oh my God, I went from the small little duplex to having a property that's over, 5,000 square feet and a bigger house, and I can paint the wall. I can kick the wall in if I wanted to do it. You know what I'm saying? So, and that's the difference. I can paint the wall, my cupboard. I don't have those restrictions that I would have when I'm renting. You know what I'm saying? I feel free. So that's the, one thing that is really, awesome about that. Now, talk about the just the process, because a lot of times people think, oh, if I'm applying for a home, it must be so complicated, and back in the day in the 80s when I was assistant to a realtor, and back then the home ownership seemed, for me, even though I was assistant to a realtor, it just seemed really complicated. But now, being in this position, it's the process is really easy. So what are some of the things that you need from a buyer in order to be able to see if they could qualify for a loan?
It's a great question. A lot has changed, to be quite honest, within the last 12 and 24 months. It used to be that you needed 2 years worth of tax returns, right? You needed to have 2 years worth of W-2s, 2 months of bank statements, all that stuff. So quite honestly, a lot of it is done digitally. When somebody completes a loan application, we get their date of birth, we get their social security number. Now, if they're not self-employed, so this is if somebody goes to a 9-to-5 job, they're a wage earner, a lot of businesses outsource their verifications of employment, right? So typically, my wife's a HR director here in Orange County, and if they don't outsource it, what happens is when somebody wants to buy a house, the lender's going to call the employer and say, hey, listen, we just want to verify their rate of pay, right? So somebody puts together on a form, hey, they've been employed with us for 5 years, they make $20 an hour. Last year they made this much, year to date they've made that much. But now so many companies are outsourcing that process that when I have a loan application where I've got a client's date of birth and a social security number, a lot of times within a click of a button, the vendor that employer is using kicks back that income information to me. So if somebody's been at a job, and even 2 or 3 jobs over the course of the last 2 or 3 years, if they use that, if the employers use that third-party vendor electronically, it comes to me and I can see what they made last year and year to date. And I honestly don't even need a W-2 in that case. I basically might just need one recent pay stub, okay? We can do the same type of thing with digital asset verification if the client is savvy enough. And listen, I couldn't even get onto Facebook in time, right? So I mean, I might need some help, but if the client is able to do that, they can actually log in as if they were logging into their bank, and the data, how much is currently sitting in the bank account, what, you know, if there were money left, that information feeds through into my electronic file. It's totally encrypted, so it's totally secure, and the client doesn't have to fax over or email me potentially sensitive documentation like bank statements or W-2s that might have a social security number on it. So to answer your question, Gloria, it can be very easy. Documentation can be as simple as one recent pay stub, 1 or 2 maybe W-2s, right? And if they're buying a house, we want to see probably a bank statement that shows where those funds for the down payment and for any potential closing costs are going to come from. But quite honestly, that stuff, depending on the client and depending on the employer, and if they use a third-party vendor, could be almost instantaneous, where I might just say, hey, you know what? I've got your W-2 information. You've been at your job for 3 years. I see that you made 50 grand last year and 60 grand this year. Just send me a just send me a pay stub and a bank statement where you plan to use the money for a down payment. Now, if you're going to get a gift because a family member is going to help out, then you can send me a letter, and the gift and the template, the gift letter that we have may be enough. We may not even need to source the funds from the donor. If it's a conventional loan through Fannie Mae and Freddie Mac, the money can be pushed from the donor to the escrow office that's handling the transaction, and we don't even need to see the donor's bank statements in a lot of cases. So to Gloria's point, and the question is, it may not be very overwhelming, and we may be able to get this transaction started and completed with just a few pieces of documentation.
And you know, just like we were saying, it's it's easy peasy. And so for me, and working with Joseph and with clients, it's like, hey, hey, welcome my new buyer. Here is he'll send you what he needs. And one thing too, the process of getting approved. So would you say, I mean, Joseph, you probably would need 48 hours, or I know you've done stuff for my clients even quicker, depends on the circumstances and what is needed. But I guess quote it would be like what, 24 hours, 48 hours.
And the question is, as far as how long would it take me as a loan officer to review the income documentation that a client sends and essentially sign off on it? Is that the question?
That's correct. Even though I've seen you done it in a couple of hours, but
Yeah, you're correct. It depends on how busy the loan officer is and the bank, right? Like, so for me, usually 24 hours is tops, um, especially if the income is straightforward. Um, even if it's self-employed, a self-employed client, to your point and to your question, Gloria, is the fact that um, a self-employed client may need to send at least 1 year's worth of taxes if they've been self-employed for 5 years or more. We can usually, in some cases, and in most cases, we can go off of 1 year's worth of tax returns. Okay, so if we're self-employed for 5 years, we may just need 1 year. If they've been self-employed just for 3 years, then we're going to need a 2-year composite or overview of tax returns to see how the business is performed. But even with tax returns, 24 hours should be more than enough time for me to be able to comb through, review the income and the expenses that appear on a credit report, and figure out how much is left over, to be spent on a house. So 24 hours, 48 hours for sure. Weekends, I mean, is there such a thing as a weekend right now during COVID? I mean, I'm working from home. It's not like I can say I'm at Disneyland with the family. So even on weekends, we do our fair share of work and process files through, for sure. Even our underwriting departments have blitzes where they go through files and approve files on weekends. And so we're cranking right now. We're cranking out loans for sure.
hey, Joseph, you mentioned underwriting,
Mhm.
and so because there's a difference from people. There's a difference from being pre-qualified versus being pre-approved.
Correct.
And I know because a lot of us, especially now, we get, you get a piece of mail from a lender and say you're pre-qualified for $30,000 in a personal loan. And for me, it's like, why do you know that?
Right.
How you know that I could have, afford, $30,000.
Right.
And so, but they say pre-qualified. Um, and then, but also too, with the lender, you could still be working directly with the lender and be qualified, pre-qualified, but not pre-approved. So can you talk about
Sure.
the difference there, please?
So the pre-qualification is, I think, the first on the rung of true approvals, right? Pre-qualification basically says, hey, I just did a quick analysis. You told me you've got a car payment for $200. You make $10,000 a month. Based on what you're saying and your expenses, hey, this is what you should be able to qualify for. That's a pre-qualification. Now, a pre-approval is when your loan officer, your bank, your lender has actually taken the time to run your credit and sees your scores, checks your income and confirms it with using like pay stubs to say, hey, you know what, I see that this person makes $5,000 a month, and we've got a credit report that shows 3 or 4 liabilities, a car payment, some student loans, and some credit card bills. And so based on that, the loan officer can, if they've completed a nice clean application, they can kind of push the button on the electronic approval, which is run through FHA, VA loans for veterans, Fannie Mae and Freddie Mac loans for conventional loans. Basically, you can run that through. And if you've completed a nice, neat, and complete loan application and you filled out the income correctly, the computer will actually tell you, hey, listen, this file meets what Fannie Mae needs, or what Freddie Mac needs, or what FHA needs, or what VA needs. As long as your loan officer did a good job and did it accurately, and they know the guidelines, fantastic. Okay. That's your pre-approval at that point. I can tell Gloria, you know what? I've got their income and their assets. The computer likes it. There's no issues. Now, if I don't do a good job as a loan officer, when the underwriter reviews the file, the underwriter might say, hey, Joe, you've missed something. Your client is qualifying based on the fact, or your approval, Joe, is based on the fact that this buyer has foster care income. Well, unfortunately, this foster care income runs out in a month, right? Or your client was approved on short-term disability, right? They're not at their job right now. And we need them to be back at work, for instance, let's say, right? It needs to be something to that effect, right? And so if the loan officer doesn't do a good job of asking the right questions or knows the guidelines enough, when the file gets to the underwriter, hey, Joe, you completely blew through the fact that this client had a foreclosure in 30 days ago or a bankruptcy 6 months ago. This loan doesn't qualify. The underwriter is going to be that last stop, the gatekeeper between getting this file to the finish line. And so you've got your pre-qualification, which is kind of just a real rough estimate, like, hey, it sounds like you got good credit, sounds like you make good money, sounds like you don't have a lot of debt. I think this is what you can qualify for if you want your payment to be right around $3,000 a month. That's pre-qualification. That's like the letters that you get in the mail for credit cards, right? Credit card company knows nothing about you, and yet you're getting offers to open up a new credit card. But in order to get that credit card, you have to call and talk to somebody. And that somebody, when they're on the phone, is going to run your credit and ask you how much you pay in rents and how much you pay on your mortgage and how much you make. And after you're done with that call and they see your credit, then they're going to tell you, hey, even though that letter told you that you were pre-qualified for $30,000 on a credit card, we're only going to give you $5,000, right? Based on the information you gave us. So it's the pre-qualification stage. Pre-approval is when your lender's really seen all the documentation. And then when that file goes into underwriting and they review the file, they are the gatekeeper and they understand what the purchasing, the purchaser is going to require, the purchaser being Fannie Mae, Freddie Mac, FHA, or VA, or USDA for USDA loans. Does that make sense?
Yeah, Joseph, and thank you. And this is why it's so important, you know, those who are looking to buy, even if you're selling and you're looking to buy, we got to go through this process to get you pre-approved. We need to get your information, your numbers, your everything about you needs to go not only from Joseph hands or any lender that you're working with. It needs to go to the underwriter. Then that way, once you get that approval and the computer give you a thumbs up, and then you know that you know that you know, unless something changes during the process, which means it's your job. Because I've had people who were qualified and then due to COVID that they become not qualified. Doesn't mean that they still can't buy later on back because they went from full-time to part-time. So as long as those things haven't changed, you know that this is what the lender is going to approve you for. You know that this is how much I'm approved for. So I don't want to go show you this beautiful house and you fall in love with it. And then we go to the lender and you find out you can't afford it. So that's not, fair to you, let alone my time as well, both of our times. We want to make sure that we go and we look at properties that you can actually afford. And so go ahead, Joe.
Yeah, I was going to say, and on the opposite end of that spectrum, right? Listen, I can't tell you in close to 20 years of doing this, that I'll sit across the table from a client and they'll tell me the information that I ask. And so we'll give them a pre-approval number. We'll give them the number. Let's call it $400,000. And we'll get in the process and we'll get started and we'll start looking at homes. And we're looking for a specific group of homes in that specific tier, in that specific bucket. Well, after 2 or 3 weeks, I've had conversations with that same client who I was sitting across the table with, and they say, oh, well, we've got more money. We just didn't tell you about it. We just didn't want to use it if we didn't have to use it. And so sometimes, and I get it, right? Gloria and I, we don't want to make somebody pay more than what they want to pay. We don't want them to get into a house and 3 months later, they're calling us at midnight because they're having a tough time making the payment. So I get all that, but definitely make sure the way I look at it is we're all on the same team, right? We're all going to work together collectively towards that same common goal. But by all means, make sure we know everything, because either A, if we've got more money, that might mean that if you find that dream house that's maybe $25,000 above your target initially, well, we can get you into that home, number one. Or number two, let's say you're holding back information like, hey, you've been informed by your employer that due to COVID, at the end of December, we're going to be laid off and we aren't going to have income. Well, that's going to come up. Okay, so let's make sure that we just know everything, because there may be a very easy solution. Okay, and I'll give you a quick example. There may be an easy solution to what you think is a showstopper or a deal breaker, but it may not be. I had a client who was a veteran, and the veteran was based and stationed out in Hawaii, but wanted to buy in California. Okay, well, the VA's basically got rules, right? Like, and they basically, if you're a military employee, if you're based in Hawaii, but somehow you're currently living, as I was with this client in LA, he was in LA. My underwriter kept asking for the work orders. Where are the transfer orders that told you that you could get up from Hawaii and move to LA County? Well, I wasn't getting that documentation. And I kept asking for it like 3 or 4 times. And I'm like, listen, I fought for you as much as I can, but underwriters are saying those transfer orders have to have happened. You don't just get up one day and stop going to the military base in Hawaii. Well, it turned out this gentleman was trying to purchase a home, and it turned out that he didn't have transfer orders, that he was actually planning to start a new career with another company outside of the military, and he was just waiting for the offer to come through. Okay, and so here I was not knowing the whole story, when the reality was all I needed to be able to use this guy's income, right? So if he's not working for the military, I can't use his income here, right? If he's not working for the military and he's not on work orders and transfer orders, then he's obviously not getting paid from the military. So that's gone. So now what income do I have left? Well, you're buying a property and you're in escrow and you're telling me that you really don't have a job from anybody. Well, there was a sweet and simple solution. And it was basically, hey, have you been given an offer letter from this other company? Yes, I have. But it doesn't start for another 45 days. It didn't matter. We could use income for a job that he was promised, right? Or a job that he had signed up for 45 days in the future. And we were able to use that income and close the loan on time rather than having to wait. So it's important to make sure that we're shopping in the right neighborhoods and for the right price points. And it's important for you to make sure that you view your lender and your realtor as part of a team, that we're all working together, and give us all of the information, and we'll figure out what information we don't need and what information we do need.
Hey, Joseph, so I want to talk a little bit about the interest rates, because interest rates are low, but how is it determined where, one person can say, well, the lender, gave me I got a 2.1, and then another buyer say, well, you got a 2.1, but the lender was only said that I can only get a 3.1. So how is that determined on how, people will get a
Sure.
lower or higher interest rate?
Really good questions, and there's a lot of different reasons. I'll go through a few pretty quickly here. Number one, it depends on the type of loan that you're getting, first of all, right? So I would say that the client who has the best credit, has money, like a good amount of money saved, will most likely choose a conventional loan. A conventional loan splits up into 2 different loan programs, Fannie Mae and Freddie Mac. Okay, so a conventional loan, you can put as little as 3% down, okay? So the amount of down payment you put will affect your interest rate, right? We're talking about banks lending money, and they're lending money against collateral. It's the same thing if you guys...
The FHA is 3 point, but the conventional, you can put
3%, you can put 3% down on a conventional loan. It's the minimum amount that you can put down, and it's not a lot, right? Okay. And so you're basically asking the bank to finance 97%, which means if the values go down in the next 2 or 3 years, that bank is looking at potentially holding the bag if you decide to walk away from that home. That's risky. And so somebody getting getting in on a conventional loan with the minimum down payment of 3% is going to have a higher interest rate based on risk than somebody who puts 25% down or 40% down. Okay, so that's one thing that might change your interest rate. There's a lot of things.
Okay, so if you put down less than someone else, that could determine,
Yep.
you know, why you may have a higher interest rate because you're putting less down.
Yep.
It becomes a more of a risk to the lender,
Mhm.
right? Okay,
Yep.
awesome. What's another?
Credit scores are another thing. If you've got two next door neighbors buying the same property, let's say they went and bought a new development. So these are brand new homes, right? And so they're each buying a model match right next to each other. But one has a 760 FICO score, which is considered excellent, and somebody else has a 640 credit score. Well, that's 104. That's a 100-point difference or more. And so the bank is going to look at that and say, well, I prefer to lend to somebody with excellent credit than somebody with less than perfect credit. So that's another reason, right? You mentioned FHA. So FHA's minimum investment on a property is 3.5%. Okay. Now, FHA rates in general are lower than on conventional loans. Okay. Which honestly doesn't make a ton of sense, right? Just on face value. If you've got the better credit and you're more financially stable, you got hundreds of thousands of dollars in the bank, conventional loans with Fannie Mae or Freddie Mac are typically the way to go. FHA loans are more forgiving when it comes to bankruptcies, recent foreclosures, whereas a conventional loan, they might not even look at you. They might say, no thanks, we don't want that. So how is it that FHA can give me a lower interest rate than a conventional loan? Well, the reason is on every FHA loan out there, FHA self-insures itself, and they use their own money to fund their own programs. And on every FHA deal, there is a charge upfront of 1.75% of the loan amount, which means if you had a $500,000 loan, 1.75% or $8,750 would be financed and added on to that overall loan amount, pushing that loan amount from $500,000 to $508,000 and $508,750. So the FHA client technically just paid $8,000 to lower the interest rate and get a lower rate through FHA than the conventional client had to. That is another reason why when you hear advertisements, you know, you might hear, hey, I can get you a 15-year loan at 2%. Well, sure you can, but maybe it's an FHA loan when the person might really qualify for a conventional loan. Because if I wanted to charge $8,000 to a conventional buyer, that interest rate would probably be just as low, if not lower, than on an FHA loan. That's one reason. On an FHA loan, in addition, you have, in most cases, the life of the loan, mortgage insurance, and that mortgage insurance is paid every month and it does not go away. And so, sure, you get a lower interest rate, but they're going to hit you with that upfront mortgage premium of 1.75%, and every month you're going to have mortgage insurance on that loan. Okay. So that's another reason why your interest rate may differ. There was another, but I'll take a quick time. Do you have a question on
yeah, that's okay. I mean, you know, and it just to, you know, I just wanted people to really kind of see, because sometimes I just want people to see and understand why they may get a higher interest rate versus someone else, you know.
And so perfect. And so another reason, and this is the one that I wanted to touch on, is listen, banks release interest rates every day, Monday through Friday. It's kind of like your gas station. When you drive by the gas station every couple of days, they've updated the price of premium gasoline or unleaded or what have you. Well, banks do the same thing. And depending on the day, kind of like a stock market, you know, you might pay one price for a stock in the morning, and by the time that market closes at the end of the day, you're paying a completely different price for that same stock. Well, the same thing happens with mortgage rates. Every day, money is pushed into the mortgage-backed security bundle of money here, and money goes in and money goes out. And if it's a bad day, we might see interest rates move in one day throughout the day 2 or 3 times. Like yesterday, we got a intraday reprice where the interest rate changed based on the performance of the bond market. And so every day the bank releases interest rates. Now, it's not just one rate of 3%. You've got rates below 3% that they'll offer you, and you've got rates above 3% that they'll offer you. Well, how do I get the lowest rate? Well, you don't get something for nothing. How do you get a rate that's less than 3%? You pay, and you pay discount points.
Right.
And discount points are a percentage. It's not a flat number like, hey, $500 gets me down here. It's 1% might get you a 1/4% lower in rate. 2% might get you an extra 1/8% lower. It's not fluid. It's not incremental. Okay. And in the same reason, you might be able to say the bank, rather than taking the 3%, you take 3.5%. And because you took a rate that's higher, that 0.5% is going to change your payment and increase it. But the bank is going to give you additional money to be applied towards closing costs that can offset those costs and those fees. So if somebody's strapped for cash, but they want to get into a home, they can essentially say, hey, lender, I need some help. I want an FHA loan, for instance, and instead of taking a rate at 2.5%, I'm going to take 2.75. And as a result, the lender and bank, FHA, is going to offer you $3,000, $6,000 towards closing costs. Or you could, or you don't get any money back.
I'm sorry, Joseph, I'm sorry there because we have about probably about 4 minutes here, and so thank you for that. And also too, I want to say, you know, I've been kind of, you know, during the Christmas season, you know, I always, you know, have the community Christmas tree that I've done for, you know, so many years, and I've been trying to shout out to everybody, and I want to thank you because you have donated toys, you have donated, you know, raffle prizes throughout the years. And so I just really appreciate you going up and above through the number of years that I've called you, and I didn't even have to beg. You just say, here, Gloria, what? So I really appreciate that. So in our 4 minutes, if you can, a lot of people, when they're looking to buy, they sometimes think that they can't buy because they're on fixed income. You know, and I tell people, I said, lenders like fixed income. They know that this is what you're getting for Social Security. This is what you're getting for your pension. This is what you're getting. So can you just touch a little bit, you know, like in 3 minutes on people with fixed income about them buying?
Absolutely. So 100%. Fixed income, to your point, is steady and it's automatic. I mean, it's mindless, right? It just keeps coming on the first of every month, you're getting a check. So that's great. You can absolutely do it. Sometimes if we're on fixed income, that dollar amount may not add up to what we were making when we were working full time. And so that dollar amount might be less, which might mean it may be harder to afford a property in these high cost areas like Orange County and LA, but may not be the case in Victorville or San Marino Valley or what have you. Also, if you can't qualify and you don't have enough money, but you have other people that are going to be living with you, right? Or you've got maybe a brother or a parent or something who is making additional money, they can join on the application and be added to that application. They can live potentially, you guys, you can actually have a relative or a family member, somebody you trust on the loan application who might live in another state. You might be buying in California and they might live in Florida. As long as the numbers match, as long as the bank sees I've got an extra co-applicant, a co-borrower who makes more money to offset the risk of somebody who's on fixed income and the income level might not be as much, the bank understands, hey, we've got a cosigner on this deal who's basically going to help out and offset any expenses. So even if somebody's on fixed income, you can look at ways at structuring the loan to where it works. Now, we don't want that client to be spending more, right, than what they can truly afford. But that's when it comes back to, let's make sure we understand the whole picture. Are there other people going to be living in this house that can help you qualify? Let's put them on the loan application and see what that works.
Awesome. And so that's the thing too, those of you, you know, if you're looking to purchase, you know, meet with us. It's just like, tell us your story. Tell us what your dream is and purchasing. What do you want to do? Let us look at where you are. And then also too, maybe there's other people that want to come in and buy property together. I want to talk to you, young people. You don't have to, to be older to buy real estate. Instead of saying, hey, you know what, I'm tired of renting, let me get with a family member, let me get with a friend who I trust, and let's get together and let's buy a house. Why I'm going to college? Why am I living in the dorm when I can actually own some real estate and so forth? And especially, now during this time that we in, it really kind of letting people, I'm starting to see more people who have been renting, they're tired of renting, they're tired of, being kind of controlled, by the owner, where they want to move out from renting to actually to be becoming an owner and stuff. So the dream is real. The dream is possible, right? Again, Joseph, I'll put your name back on here, Joseph, because I wasn't sure if you were going to make it. So, Joseph Phillips from Caliber Home Loans will definitely have to come back because, talk. This is something that really, we're looking at every second Wednesday, 10 o'clock. Come meet us, talk to the lender, talk to, the realtor, have those questions asked. And maybe next time, also we'll maybe dig a little bit deeper into veterans and VAs, because, because as we know, a lot of veterans, okay, I'm approved. I have my VA, but yeah, you still got to talk to the lender. You still have to do these things, and the lender still has to look at your documents, and you still got to get yourself in a position so you know exactly what you can and cannot do. And that's another topic. So those of you, reach out to us and just say, hey, you know what? I want to see where I'm at. And here's the thing, if you're not in a position to purchase now, we will help and guide you to be able to get to that position. But you got to start. You got to take that, step of faith, like I did. And again, Joseph Phillips, he has saved even clients of mine and stuff. So Joseph Phillips, Cavalier Home Loans. How do they reach you, Joe?
Reach me, I'll give you my cell phone. It's area code 562-810-4570. My email is simply my first name and last name with a period in between it. Joseph.phillips@caliberhomeloans, plural.com. So that's joseph.phillips@caliberhomeloans.com. But yeah, you can reach me. I just threw my information there on the chat. I don't know if anybody's able to see that, but
I'll add it to the page there.
But
the thing is
yeah,
that make sure that when you call Joe, you say, hey, you know what, Gloria's my buyer or my realtor. So anyway, thank you, Joseph, for being here. Really appreciate you. Any last remarks?
No, it's a pleasure. Thanks for having me on. I apologize for being tardy, but 100%. We work as a team, right? Gloria and I. And so we'd be happy to answer any questions you have. And even if it's something where you're not ready to buy right now, and you think you want to just make sure that you've got all of your ducks in a row for when you are ready to buy, whether that be in 3 months or 6 months, let's have that conversation and let's make sure that we're doing whatever we need to do to ensure that when that time comes, we're in a perfect position. We've got better credit scores, we've got lower debt, whatever that item is, let's figure out what it is so that we can get you closer to being a homeowner.
Awesome. Again, thank you. Thank you for those who are viewing. Please, make sure you share this, and someone who is, wanting to buy, wanting to sell. We are here to be able to help, and it's great to be with people that you can definitely trust. So again, I thank you. Joseph, you saw my email last night, so I got to run and show a property, but I'll call you on my phone. Okay. And thank you, everyone, and enjoy the week, and wear that mask and be safe.
Happy holidays. Merry Christmas. Yeah. Happy Kwanzaa.
Bye.